Hello everyone, my name is Tijana. I'm a strategy associate here at Nomad Capitalist. In today's video, we will discuss one of the controversial topics in the recent times, and that would be the Maltese tax pension plan loophole. So when it comes to US citizens, they've been trying to find ways to reduce their taxes, legally or not legally, but in most cases, they were going to the Caribbean, to some of the Latin American countries, some places like even Switzerland, which is a very high tax, and Malta was in a way disregarded for a very long time. Now, looking at Malta, and after the World War II, everything they have done is introduce all these new tax incentives that would bring in people and companies in. So back in 2011, there was a tax treaty drafted between the US and Malta. And based on what the US says about this, it was a very poorly drafted tax treaty. So what happened was there was a loophole that was exploited by US citizens who actually learned about it. It was very low on the radar, so not many people were aware of this loophole existence, but those who did have taken advantage of it. Essentially, the loophole was about a pension plan in Malta. This pension plan would look something, to those of you who are US citizens, this would be very similar to a Roth IRA. Now, this pension plan was a supercharged Roth IRA in Malta, and it would not incur any taxes on US citizens contributing to this pension plan. And in addition to that, Malta would not impose any local taxes. Malta always wanted to attract new people coming into the country, new businesses coming into the country, and therefore they would just not impose additional tax. And it is well known that Malta is a tax-friendly country. So essentially, there was a point where I was reading about this, and one of the authors of one of the articles has said that whenever a tax strategy is publicized in a Wall Street journal, it usually means that we're very soon going to see the end of it. So when it came to the Malta pension loophole, it was actually published in tax notes. Now, imagine every tax professional in the US, of course, reading these articles, and they have looked into every possible way to actually get rid of this. And that is what actually happened. So recently, it has been ruled out that this is a possibility, and it's no longer a tax-free option, and people will no longer be able to take advantage of this. Now, of course, these loopholes do exist, and we will be looking for them alongside with you. So as long as everything is legal, of course. But Malta pension plan is no longer an option for US citizens. Now, it can be optional for some other nationals. However, US citizens would be excluded from this. IRS does claim that they did not make any mistakes when drafting the tax treaty. What happens is, in the tax treaty, it clearly says that a fund, scheme, or a contribution to a pension plan or retirement plan made by an individual, if it's made in any property other than cash, and if it is not directly connected to benefits from the employment and income earned throughout their life, then it would not be applicable in this case. In addition to this, if the distributions are not received as actual retirement and pension at their older age, then this would again be not applicable in the case of the Maltese pension plan. So many of the US citizens actually did go for this deal. So many have been affected, and right now we are looking into what is going to happen to those who have taken advantage of this loophole. IRS is not going to give up on any of the claims they believe they are entitled to, and what they're claiming is that no change to the tax treaty is needed. Essentially, the only thing that is happening is that those taxpayers were led astray and they did not file their taxes correctly. So considering the fact that the tax treaty has been out there since 2011 and this loophole has been discovered only about 2 years ago, we're looking at a tax period of 10 years of people who have taken advantage of this. The first thing that has to happen is amending all of the tax returns, paying tax on all the tax that was unpaid. And in addition to that, we have a problem where some of these pension plans could be considered a foreign grantor trust. So it is a contribution to a foreign plan, which can be considered a trust, and therefore those taxpayers would not be in compliance because they have not filed any of the 3520A forms. And all of those will carry a penalty of at least 10,000 US dollars. So Maltese loophole is not the only one out there, and we are witnessing many, many legal ways to reduce taxes, and that is something that we do here at Nomad Capitalist. If you have been affected by Maltese pension plan loophole and you need assistance, or if you have discovered a loophole that you believe is true, it would be a good idea to check with tax professionals or simply apply on our site to become our client, and we can help you look into the situation and we can determine if this loophole actually does exist and if it is something that would be a right step for you.